Well, good afternoon. My name is Nathan Stelter, president here at the Stelter Company, and thanks as always for joining us for our webinar today. 5 key financial planning trends that will impact giving, presented by Juan Ros, partner financial and financial advisor for Forum Financial Management. I'll get back to introducing Juan in just a quick minute, but first want to say a couple words about Stelter's webinar series. As an expert advocate for asset-based giving, Stelter is always committed to providing innovative solutions and education for the nonprofit industry. We pride ourselves on being what we call a bridge builder for the community and are happy to host this free webinar today, connecting you to experts like Juan from across the country to assist you in maximizing revenue across your development portfolio. Today's webinar is actually our 4th of our 2024 webinar series, and we still have a lineup of great speakers later this year. The infamous and always exciting Pamela Jones-Davison will join us later this year. John Kendrick, formerly at George Washington University, is going to lead a panel around challenges, legacy challenges, and then Meg Klein from University of Illinois Foundation will be joining us, just to name a few. As always, Jen is on top of this, so look for your personal invitations in your inbox for each webinar. If you've missed any of our previous webinars and or want to sign up for future ones, go to stelter.com/webinars, and you can find all that information there. Back to today's webinar, as Jen mentioned, we're going about 75 minutes today. Excited to have Juan with us. Juan's spoken for us in the past and had some great feedback and great Q&A, so definitely feel free to put those questions in there. But as you can see, Juan's bio there, he's a partner and financial advisor for Forum Financial Management. Prior to joining Forum and its predecessor firm, Lamia Financial Group, Juan held various senior fundraising positions at the Ronald Reagan Presidential Foundation, Occidental College, and the ALS Association, to name a few, helping to raise millions of dollars in current and deferred gifts. I'm not going to read all this because you can read quite a bit of it for yourself, but just to highlight a couple things here. Juan works really closely with legacy-minded families and business owners to enhance, protect, and help transfer their wealth. Since 2015, Juan's actually served on the faculty of the American Institute for Philanthropic Studies, which awards the CSPG designation, and has been a frequent contributor and member of the editorial board for the terrific publication, monthly publication, Plan Giving Today. Juan's is a certified financial planner. I was just going to say CFP, but there you go. Also holds the CSPG certified specialist in plan giving designation, accredited estate planner designation, and certified exit planning advisor designation, and one more, certified value growth advisor designation. So he's been doing quite a bit along with an MBA. Really excited to have Juan with us today. He is joining us from Arizona, where it's always a nice dry heat this time of year. I assume we're in the three-figure 100-something today, but he has recently relocated there, and so excited to have Juan joining us. And we'll hand it over to you, sir.
Wow, Nathan, thanks so much for that introduction. I really appreciate it. Yes, it is. We have a high of 105 today. It's only 95 at the moment. The hottest part of the day is usually like from 3 to 6 p.m. That's when we stay indoors. We have nice air conditioning to keep us cool. But I want to thank Stelter Company. As a past client of Stelter Company, I know all about the great work that they do on behalf of nonprofits and in the plan giving space. So really appreciate them inviting me to give this webinar. This is going to be a little bit of a different perspective just because of my background as a former gift planning fundraiser and now a financial advisor. And so this is kind of my perspective on some key financial planning trends that will impact giving. And so let's just hop into it because I've got a lot of slides, a lot of information to get to. But first, what I want to do is really set the table about what we're talking about here. So let's start with some definitions. What is financial planning? We're talking about financial planning trends. Well, let's define financial planning. Financial planning is defined by the CFP board, the Certified Financial Planner Board, as a collaborative process that helps maximize a client's potential for meeting life goals through financial advice that integrates relevant elements of the client's personal and financial circumstances. Now, I don't know if you can see there's 3 words bolded in that definition that I bolded: collaborative, process, and integrates. It's a collaborative process, meaning we like to work with other professionals along, all in the client's best interest. It's not just a one person, doing all the planning, him or herself. It really requires a whole team. It is a process, so it's not a one and done. Financial planning is not something where you spit a plan out of a piece of software and you hand it to the client and say, okay, there you go. Here's your plan. Have a nice day. No, it evolves. It's very fluid. It changes all the time. I talk about getting a client's entire financial house in perfect order and then keeping it that way forever, because it's one thing to get it in order, and that usually takes a couple of years, but then keeping it that way, because there's going to be things that happen to get it out of order. That's part of that process. And then it's integrative, because it has to take into account what the client is trying to accomplish. It has to take into account their most deeply held values and their most important goals. And that will help shape the recommendations and the planning advice. So that's financial planning defined. My objective here is for all of you as gift planners to begin to think like a financial planner. Back in January of 2015, it's been almost 10 years since I first gave this presentation called How to Think Like a Financial Planner, and I did that in Los Angeles. And so it's I kind of coined the term, and Jim Normandin, who probably a lot of you know, he saw that presentation. That's what led him to reach out to me to become a professor for the CSPG designation. But I'm not looking to have you be the donor's financial advisor, because you can't. That's not your role. But it's a different thing to start thinking like a financial planner and to have that holistic perspective mindset when you're going in and talking to a donor, you're asking questions, you're gathering data, I think it will help you become a better gift planner to start thinking like a comprehensive financial planner. So that's my objective. And the reason that I can say this is because if you look at the steps in the financial planning process that are outlined here, understanding the donor's circumstances, identifying their goals, analyzing their current course of action and any potential alternative courses of action, then you developed the recommendations, you present the recommendations, you implement the recommendations, and then you monitor progress and update as needed. Those steps in the financial planning process, they are identical to the steps, in my opinion, in the gift planning process. You're doing the same things. You're just doing it within a narrow kind of area of the donor's life, which is philanthropy. But I would argue that in addition to doing that, you also need to take into account the rest of the donor's situation, their personal financial tax situation, as you move forward in this process of understanding their circumstances, identifying goals, analyzing, developing, presenting, implementing, and monitoring. So now we've defined financial planning. What's a trend? Well, a trend, according to the Cambridge dictionary here, is a general development or change in a situation or in the way that people are behaving. So it's a general development, a change. One trend that you're not going to hear me talk about today, because I don't believe it is I don't know that it fits the definition of a trend yet, is AI, artificial intelligence. That, I think, is still too early in its infancy to really be considered a trend. It's kind of a fad right now. There's a lot of hype about it, but what is it really doing in terms of a financial planning trend that will impact giving? I just don't see that quite yet. Maybe if I do this presentation in 2 or 3 years, that'll be a different story. But anyways, here's your definition of a trend. So the meaning of all of this, again, is that gift planners should develop an awareness of these trends as you're reading the news, you're talking to donors, you're talking to other professionals, the trends that can affect the donor's circumstances, and therefore potentially the gift recommendations that you can make to a donor. All right, so let's get into it. We'll hop into the first trend, and that is business succession. By the way, I also want to commend Aaron Levinson. A little shout out to Aaron for his question about snacks. Sorry, there are no snacks in this webinar. Thank you. All right. There's a huge we've been hearing about the wealth transfer for a long time now. So here are some more recent numbers about this wealth transfer. So between now and roughly 2045, it's estimated that about 84 trillion with a T dollars will transfer wealth. Now, if you look at business owners as a subset of people who will be transferring wealth, 80 to 90% of the owner's net worth is generally in the business. It's this asset that's generating cash flow, that's increasing in value. It is an illiquid asset, but it's worth quite a lot when you look at their overall balance sheet. It's a big part of their net worth. And so you're going to see this significant wealth transfer. It's already happening, starting to happen via business interests or some kind of a liquidity event where the donor sells a business as part of a business exit plan. So there has been, and now that this is kind of becoming a much more broadly accepted trend, you're seeing that there was this unmet need for professional advice and resources to business owners around succession and exit planning. So there's kind of a vacuum, a hole in the planning for this. It's not something that was really talked about a lot, but that has changed really in just the last couple of years. So now you have a couple of organizations that are stepping in to meet that need for education primarily to business owners. The Exit Planning Institute is one of the largest. They have exploded in growth. They are a for-profit entity, so just be aware of that. The Association for Corporate Growth, ACG, is another one that steps in to provide education to business owners and to the professionals who serve business owners, primarily around this idea of exit planning and succession. So knowing all of this, what is a gift planner to do? Well, first of all, I'd suggest you want to identify the business owners in your database. And we're really talking about donors who are maybe in their maybe to mid 60s to early 70s, because if you are a business owner in that age range and you have not yet thought about, planned for how you're going to exit the business, what is your succession plan? That's a key planning gap that needs to be filled by somebody. And then in addition to identifying the business owners in your database, you want to do a lot of data gathering, which is what you're good at as gift planners. Ask questions. So what questions can you ask? Well, first of all, do you currently own a business? That's kind of an obvious one. You should already know this, but let's assume that you're speaking with a known business owner. Okay, what kind of business is it? If you're meeting them at their home, maybe you don't really know. Obviously, if you're meeting them at the business location, you'll know the answer to this, but is it a manufacturing, construction, retail, etc.? What kind of business is it? Then how is the business legally structured? Is it a sole proprietorship or an S corporation or a C corporation? Is it an LLC? Is it some kind of partnership? That's going to be a key question to really understand the business, so that because it's going to drive potential gift planning recommendations. What is the ownership structure and what are those percentages? Who owns the business and how much do they own it? And sometimes there's a very easy 100% single person business owner. Sometimes it's two people and they're 50-50. Sometimes it's two people and they're not 50-50, or 3, 4, 5 or more people. Sometimes if a business owner, particularly in the startup world, they bring on investors and those investors own a piece of the business and the shares get diluted. So they may think that the shares that they own are worth a certain amount, but in fact, because of additional investors coming on board, the value of those shares has gotten diluted. I've seen that happen. Very important thing to know. What is the value of the business? This is really what it comes down to. Just like for homeowners who think they know what the value of their house is, they generally inflate the value of the house. Business owners are the same way. They will generally inflate the value of their business. They'll think it is worth more than it actually is. You want to ask how, if they give you an answer, how is that value derived? Did you do a professional, formal business valuation, or is this just something that maybe your CPA thought based on book value or something like that? Value of the business is a key one. Have you made any concrete plans to transfer the business or provisions? Like, what are you doing? Because at some point that's going to happen. You can't avoid it. And a lot of business owners are either too busy working in the business to think about what's going to happen to the business. And if you haven't made any plans, how would you ideally like to transition the business? And by when? Is there someone internally that you would want to pass it on to? Are you thinking about maybe have the employees do an employee stock ownership plan? Is there a family member, one or more family members involved in the business that you would transition to? Or did you just want to sell it to somebody on the outside? A lot of different options there. A few more questions to ask, and now this comes in the category of more kind of qualitative questions. Do you feel you're ready to exit the business? And if not, why not? If not, by when do you think, So that's the owner. The second question, do you feel the business is ready to be transferred? Is it in a condition where a buyer would look at the business and say, this is worth a lot. I want to buy this. Think about a home. If the home is, you have a realtor, when we sold our house in California, we had quite a bit of stuff amassed over 18 years. And our realtor, she was so sweet. She's walking through the house, and as we're going to list the house, so she's going to have open house. She's like, yeah, I think maybe we get rid of this. And I think maybe this kind of goes into storage. And I think, so she was being in a nice way, saying that we had too much crap and too much clutter. And if we're going to stage the property properly, we need to get rid of it. So our house wasn't ready to be sold. Is the business ready to be transferred? Is it in a condition where it's ready to be transferred? And do you have a business succession team in place to provide you with the necessary guidance, legal, tax, financial? throughout this process. I'll tell you that sometimes, a lot of times a business owner will have a team in place. They'll have a CPA they've worked with for a long time. They may have a financial advisor. They may or may not have an attorney, but they may not be the right people to work on the succession, on the exit planning, because that takes a specialized set of knowledge and skill and expertise that sometimes everyday CPAs and financial advisors maybe just don't encounter on a regular basis. Sometimes you have to complement the existing team with other professionals. And here's a key one for all of you out there. Would you be open or interested in a strategy to transfer or exit your business that includes a charitable component? And that's all you need to ask. You don't necessarily need to know all of the details. If the answer is, I'd be open to it, now you're off to the races. If the answer is no, then you can maybe close the door on that side of the conversation. But the gifts of business interest, that's a really complex topic. That's not what I'm going to talk about today. I can do a whole other hour on that. But there's a couple of key factors that will affect what kind of a potential planned gift could be implemented with a business interest. It depends on whether the gifting happens before the exit or sale or after the sale. It depends on the type of legal entity, like S Corps can be a little challenging versus C Corps a little easier. Is it a gift of, if there is going to be a gift, is it the assets of the business that are being gifted, or is it the shares of the corporation or an interest in the LLC or partnership that's being gifted? So that's a topic for another time, but just know you don't need to know all of those details right now. You just need to ask the right questions. So here are your hacks for this first trend. You want to identify the donors who are business owners. You want to ask very pointed, probing, thoughtful questions. You're gathering data by doing that. I would also encourage you to do some networking. Check out if there is an Exit Planning Institute or ACG chapter in your area and go to a meeting. You don't have anything to lose. You get to meet some of the professionals involved in M&A, business transitions, and there may be some connections you can make there. And by doing that, you want to grow your professional advisory network, whether it's formally or just informally, with those experts and professionals who work with business owners on a regular basis in that mergers and acquisitions space. All right. Okay. Moving right along, that's the first trend. How about this trend number 2 is the rise and fall, or rise again lately over the past few weeks, of crypto and alternative asset classes. So this is an interesting area. Let me define what I mean by alternative investments. It can mean a lot of different things. That term gets thrown out a lot, especially in my industry. It could mean digital assets. It could mean also commodities like precious metals, oil and gas. You got timber out there. It could also mean investing in hedge funds or private equity. There's options strategies that are considered alternative. There's structured securities. There's all sorts of kind of crazy stuff out there. Anything that's not traditional stocks, bonds, cash, and just real estate is pretty much considered an alternative. Okay, so just want to be clear on what we're talking about here. Now, how does someone access alternatives? If you're an investor, think about your donors, or you yourselves in your own personal investing. How do you access the alternatives? There's really 3 ways. There's a direct investment. So let's say I have a couple of clients that, they know some people, they have friends, and they talk, and then they say, hey, there's this fund that my friend is opening up, and I want to put in a couple $100,000 into this private fund. I don't know if it's going to do anything, but it's this investment in whatever. So that's a direct investment. There's a prospectus and an agreement, and then you make a commitment to subscribe to a certain amount of dollars, and there's capital calls, and it's all this kind of stuff. You have to be an accredited investor in order to participate in a private offering. If your donors have some wealth, they would most likely be accredited investors. There's a specific definitions for that. Or you can just buy an exchange traded fund, an ETF, that you can buy that through a regular old brokerage account at Schwab and Fidelity and E-Trade and wherever. Those are called liquid alts because they're easily traded. A fund can be traded during the market hours. It's not like your money is locked in for a certain period of time like it is with the number 1, the direct investment. You can sell it at any time and get out, either a profit or a loss, but you can sell out of it at any time. Anyone can purchase ETF shares. You don't have to be an accredited investor. And then there's a third method, which is like the crowdfunding platforms. There's a few of those out there like Yield Street or Masterworks, which is specifically for fine art. If you want to invest in fine art, you put money into Masterworks and you own a little bit of a bunch of art. Vint for wine. I mean, there's all sorts of weird platforms out there. I would argue that your donors are probably not using those. That's really more kind of younger investors who look at these crowdfunding platforms. But I just wanted to present it as another option there. Now, these liquid alt funds that I'm talking about, again, these funds that are traded during the day on stock exchanges, you can buy and sell them just yourself through a regular brokerage account. Those have exploded. As you can see, this is a chart going from 2006 to the middle of 2022. There weren't that many. And then these are 3 different types of funds. And then by the end of 2022, there was a whole lot of them. I mean, still relatively small in number compared to stock and bond funds, but it's quite an explosion. Because, you know, let's be honest, financial institutions, they want fees and money. And if this is something that investors are hungry for, they will issue products to investors to collect those fees. All right. Then there's cryptocurrency. It's a whole other thing. Here's the definition of cryptocurrency. It's a digital or virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend. All right. If you can understand all of that, then you can also understand, hopefully, that many cryptocurrencies are decentralized networks based on blockchain technology. Blockchain technology is a distributed ledger enforced by a disparate network of computers. So, that's a lot. But that's the formal definition of cryptocurrency. All you need to really know is that it's digital currency. It's money that's not, it's zeros and ones in a network. All right. Now, how do you invest in crypto? A couple of different ways. You can invest in it directly in what's called the spot market. That means you open up an account at a crypto exchange and you put dollars into that crypto exchange. And then with using those dollars, you buy crypto. And now suddenly in your account, you have crypto instead of dollars. There's another way, and that's through mutual funds and ETFs. Now, prior to January of this year, mutual funds that were crypto funds, they only provided indirect exposure, meaning you could not buy, if you had a crypto fund, that fund itself wasn't buying the crypto itself. It's like a Bitcoin fund. It wasn't buying Bitcoin inside the fund. It was buying either a futures contract or it was buying stocks of companies that had some relation to crypto, but it wasn't the crypto itself. Now, in January, the SEC approved a spot Bitcoin product. They said, okay, financial institutions like Fidelity and Grayscale and a bunch of others, you can now have these products, and these funds that you will offer can buy the crypto itself directly inside the fund. And so investors can then buy shares of that fund, and they will own the crypto inside the fund. So the next day, ETFs hit the market that directly invest in Bitcoin. And then just this month, today's the last day of July, Ether ETFs were launched for trading. That was just like last week, as a matter of fact. So is this a huge shift in trend where now you're having funds that people can own, and those funds directly own the crypto as opposed to indirectly? Yeah, that's actually a pretty big deal. But the question is, if you're taking a step back from a financial planner standpoint, is alternatives or crypto, are those a hedge against stocks? So if stocks are, if you think about diversification, which is kind of the golden rule of planning, you want to own a bunch of different things that don't all move in the same direction, because you're going to have some things that are going to do well, some things that are going to underperform. And when something does really poorly, you want something else to be doing very well, so that your overall risk is kind of, it's muted by the fact that you've got this diversification. You don't have all your eggs in one basket. Well, here's some figures for the last 2 years. The first index that you see there is a commodity index. So this is just broad commodities that you can buy. In 2022 did great, 26%. That's awesome. Oh, but in 2023, it was down 4.3%. Compare that to the good old-fashioned S&P 500. It's large U.S. stocks. Yeah, in 2022, the S&P 500 was off 18%. And that was primarily because of all the interest rate increases from that year, which we'll talk about shortly. But then the S&P really had a nice rebound in 2023, and it was up 26% that year. And then NASDAQ, the crypto index, which is the only index that I'm aware of that follows cryptocurrencies, in 2022, it was down almost 2/3. That was huge. And then in last year, it was up 132%. So in terms of volatility, those are huge swings, particularly in crypto. The bottom line here is that these alternatives, whatever kind of alternative you're talking about, they're really volatile, because they don't have the same characteristics as just good old stocks and bonds. They're very sexy and people like them, and they're kind of in the news a lot. But just for future planning purposes, just know that they are very volatile. And if you're buying these funds in any of these alternatives, including the crypto ones, they're generally more expensive than just a plain old index fund of stocks and bonds. Some of the new Bitcoin ETFs, I'm not sure about the Ether ones, we're waiving their fees temporarily, but then eventually they're going to charge these fees. So anyway, it's as an investor, it's more expensive to own on top of the volatility. So thinking like a financial planner, let's go back to that. You always want to do what's in the client's best interest. And here's the moral of the story in this trend. When it comes to alternatives and cryptocurrencies, their popularity does not mean that they are appropriate within a client's portfolio. Just because something is popular, it's in the news, and maybe someone has FOMO about it, that doesn't mean that's appropriate for that particular client or donor, okay? So here are some hacks for you as gift planners on this trend. Understand if the donor shows you, this is what I have, these are my assets, and you see something weird like this, an alternative investment of some kind, you want to understand what exactly that is. What does the donor own? Is it a direct investment? Like if the donor's an accredited investor and they bought into some fund, some kind of investment of some kind, some private offering. What is it? How much have you put into it? What's your cost basis? Do you have an expected return? Have they kind of told you this is what we think the fund will earn, and whether or not it actually does is a whole other story. You've subscribed, you've committed to a certain amount of dollars. Have you met that commitment, or are there going to be extra capital calls, more money you have to put into this thing that can happen at any time? How long is the holding period? In other words, how long is your money locked up for? Is it 10 years? 12 years? And what's the exit strategy? It should all be in the prospectus that they received when they first bought into this thing. Or is it just a mutual fund or ETF through a brokerage account? And if it is, you want to know what's the expense ratio, which is the cost of that fund. That's publicly available information. How much is this fund costing the investor, the donor, to own in their account? Okay. If the donor owns crypto, where is that crypto held? If it's in a brokerage, if it's one of those new ETFs, either a Bitcoin or Ether ETF, that's different because that's easy. It'll be in their investment account. But if it's in some kind of a crypto exchange, you want to know where that is. Which currency or currencies does the donor own? Is it just Bitcoin? Is it Ether? Is it Dogecoin? I mean, there's so many of them out there. And if it's not owned by just a fund in the brokerage account, are there safeguards in place to prevent the loss of that crypto or the loss of the donor? The donor usually needs a digital key to access their crypto if it's held at an exchange. I remember there's been cryptocurrencies that have been in the news a lot the last couple of years. That Terracoin was supposed to be very stable, and then it lost a bunch of value. Of course, FTX with Sam Bankman-Fried, that was a whole mess. That's still being sorted out. So you just want, again, this is about asking questions and understanding. Then in terms of giving it away, well, if it's a mutual fund or an ETF, that's the easiest. That's just like any appreciated security gift. And they can give that away into your brokerage account from their brokerage account, super easy peasy. If it's a direct investment or one of the, or some, in some kind of alternative investment, some kind of offering, that's generally going to be illiquid. They're probably not going to be able to transfer it. There may be transferability restrictions. So you're going to want to find out if this thing can even be transferred to charity, whether or not you want to accept it. There could be valuation issues, like how do they get that interest appraised? They'd have to have a qualified appraisal and all of that kind of stuff. So for something like that, I would definitely partner with a large donor advised fund. You know, Brian Klontz, for example, Decamai Foundation, that has experience in accepting these kinds of gifts. And then if it's just good old cryptocurrency that's not in a fund, they just own it outright. Is your organization equipped to or prepared to accept crypto? Like a transfer of crypto into your account? You're gonna have to open an account. Again, I would partner with a community foundation or a donor advised fund that accepts gifts of cryptocurrency just to get the risk off of you. You know, that's where you can do some nice partnering there. So that's the second trend. And remember, a qualified appraisal is needed regardless for the deduction of $5,000 or more on gifts of illiquid assets or even cryptocurrency. The crypto itself, if the crypto is gifted, that is still subject to the qualified appraisal rules. All right, moving right along. Trend 3. When I first gave this presentation, this trend was called rising interest rates. Now that we've been in a high interest rate environment for, the last time the Fed raised rates was last year in June or July. This is called higher interest rates. So let's look at the Federal Reserve's interest rate history. Here's a chart going all the way back to the 1950s, and you can see that interest rates really spiked during periods of there's like recessions. And so in the early 80s is when interest rates hit their peak. That was when they were just shy of 20%. crazy, crazy. And then it kind of this long trend downward. And then more recently, you'll see, you know, kind of, we've had this kind of flat line at the very bottom of the graph, and then kind of a zip up, which is the more recent interest rate hikes. But again, going back to that recent history, after the financial crisis and after the start of the pandemic, the Federal Reserve pushed interest rates to almost to near zero, which is the lowest they've been. That's why a lot of people have these low interest mortgages. Savings accounts weren't paying anything. So borrowing was very, very cheap. And that was kind of for an extended period of time. I mean, after the financial crisis, they didn't start raising rates again until what, 2015, 2016. And then as soon as the pandemic hit, they dropped them back down to zero and kept them that way up until 2022. So that's been kind of the recent history on the Federal Reserve. So there's something called the yield curve. You may be familiar with it. This is the yield curve at the end of 2021. So what you're looking at here is a plot of United States treasuries that are issued by the Treasury Department. Along the bottom is the maturity of those treasuries, going from the shortest on the left at 1 month to the longest on the right at 30 years. And then on the y-axis, that's the interest at which those treasuries were trading on that particular day at the end of the year. So it goes from 0% at the bottom all the way, the upper line is 2%. So at the end of 2021, the highest yielding treasuries were under 2%. That's the 30 years all the way on the right. And this is actually a normal looking curve where the shorter the maturity, the lower the interest that's going to pay, because again, think about risk. If you buy a treasury that's going to mature in a month, that's very little risk. So you're going to expect very little return on that investment, as opposed to something that takes much longer to mature. You're going to require more interest because you're holding it for longer, and there's more risk because who knows what's going to happen over 10, 20, 30-year period. So this is a normal looking curve that kind of slopes from the bottom left sort of to the upper right. Let's look at that curve as of a couple of weeks, last week when I finalized this presentation. Very different looking. You have the left side of the curve that's on the high end, and then it drops down, and then the treasuries on the right-hand side, which are your longest maturities, they kind of blip up, but they're nowhere near as high as the short end. This is what's known as an inverted yield curve because it's not sloping from the bottom left to the upper right. It's going from the upper left to the bottom right with a little bit of a kind of a wiggle there. So if you plot them together, now you can see that the y-axis, where the interest rate is, goes all the way up to 6% is the top line, whereas before it was 2%. Now it goes up to 6%. The red one is December of 2021. The blue one is just last week. So you can see that there has been a rise in interest rates. It's just very clear right here, regardless of the shape of the curve itself, you know, and whether it's normal or inverted or anything like that. The whole curve itself has moved up the chart and is now much higher than it was at the end of 2021. It's a function of the Federal Reserve pushing those lower end rates, and then investors push up the other rates. And so now you have mortgages that are lately just under 7%. You have savings, high yield savings accounts that are paying 5%, money market funds paying 5%. 2 years ago, that was not the case at all. It was still very, very low interest. So what does all this mean? Well, let's think about it from an investment standpoint. Investors usually own stocks and bonds. When interest rates go up, the value of bonds, existing bonds, goes down. It's an inverted relationship. Interest rates go up, value of bonds goes down. So what happened in 2022? Interest rates shot up in a very short period of time. What happened to the value of bonds? They sunk in 2022. This here is a chart of the bond returns. This is a bond index. So if you just forget about stocks for a second, every year from 1981 to 2023. And you can see here that prior to 2022, you had just in a year in which bonds were negative, it was just a little tiny negative. Like 1994, bonds were down 2.9%. That in 1994, that was like, oh my God, bonds are down almost 3%. It was like a nightmare scenario. Well, look at the 2022 line. That is like whoop, way down there. And so in fact, 2022 was the worst year for bonds ever. The US bonds lost 13%. So that little line there in 2022, which is the second one from the right, that's at negative 13%. And then that was in the US, and internationally it wasn't much better either. International bonds were off almost 10%. So this is just for bonds. This was like apocalypse. It was like really bad. So, and is there a cause and effect? So you had these bank failures, Silicon Valley Bank, Signature Bank, all of this kind of stuff that happened because interest rates went up so quickly. You had these bank failures were in the news. They weren't prepared for it. So that was 2022. How have things been since? Well, let's look at last year. US bonds were positive. They didn't quite make up all for the loss of 2022, but they were up 5.5%. International bonds last year were up 8.3%. So pretty nice return. Year to date, as of the end of June, US bonds were just slightly negative, and international bonds were just slightly positive. Not a big deal. But here's the thing. Your donors tend to be older. They are often on fixed income or living off the investment returns from their portfolio, as well as Social Security and any other sort of income sources. Portfolios for older donors are generally more heavily allocated to bonds. This is why I spent so much time kind of talking and giving you kind of this baseline about bonds and what they've done recently, because their portfolios, from a financial planner standpoint, I want my older donors in retirement to not have so much stock market exposure if they don't need it. I want them to be more heavily in bonds and fixed income because that's less volatile for them. And then if there's a market downturn in the stocks, they don't own a lot of stocks, they won't be as impacted by it. Well, in 2022, the returns were lousy for both stocks and bonds. Stock market did terribly, bond market did terribly. It was unbelievable. There was nowhere to hide. And so your donors might be concerned, even today, even a year and a half later from 2022's bad returns, about the ability of their investments to keep up with today's inflation, which is still kind of on the high side, and maintain their lifestyle. And that's even after last year's bond rally. So I think there's still concern out there among your older donors. So again, thinking like a financial planner. A lot of what I do, a lot of financial planning, and I'm sure you experience this as well in gift planning, it's behavioral. Yeah, it's emotions and behavior, and it's not so much about the numbers themselves, but the response to those numbers. And so good communication is going to be key here. What do I mean by that? Here are some hacks. The AFR, the applicable federal rate, which is used to calculate certain charitable deductions of like CRTs and other things, it went from 1.6% in January of 22 to 5.2 at the end of that year. I mean, that's a huge jump. Huge. And in August, which is next month's AFR, it's still going to be it just coincidentally happens to be at 5.2% for next month. So in a short period of time, the pendulum swung away from charitable lead trusts, which were a boon if you got any when the AFR was low. The AFR got to 4% was like the lowest. Hopefully at that time you were talking to donors about lead trusts, because the leverage on those lead trusts was fantastic. Well, now the pendulum has kind of swung away from lead trusts. Lead trusts still have their application. I'm not saying that they're not a good vehicle. Estate tax minimization would be a good application of lead trust, even with higher AFRs. But charitable remainder trusts and gift annuities are going to be more attractive at this point with these higher rates. And also online savings accounts. Like I said, they're paying, there's some high yield accounts paying 5%. CDs, those rates have all gone up. Money market interest rates, everything is higher. And for donors who have a lot of bonds, those bonds pay interest, as we saw on the yield curve. And that interest is now pushed up higher on the chart in terms of the interest that those bonds pay. So to the extent that they have bonds in their portfolio, that income, the cash income out of those bonds, whether they're individual bonds or in funds, has increased significantly because interest rates, yields have gone up. So they're actually generating more income in their portfolio from the fixed income side of their portfolio than they were just a couple of years ago. So you want to be mindful of client emotions, particularly during volatile times in the markets, I mean, at all times, but particularly during volatile times. And maybe communicate that the news is not all bad. Hey, there are better savings rates. If they have their savings account at like a big bank that's still paying under 1%, it might be time to talk to them about moving it to a savings account. There's a bunch of them out there, mostly online, that are paid close to or at 5%. And that their bonds in their portfolio have higher expected returns moving forward because yields have gone up so much. Now, there's this talk of the Federal Reserve cutting rates. In fact, they're meeting today, and there's some expectation that rates will get cut maybe once or twice this year. Well, if that happens, now the trend starts to reverse, and the pummeling that donors' bonds in their portfolio took in 2022, if interest rates go down, the price of bonds goes up. It's an inverse relationship. Now their bonds are back with a higher value, and their portfolios will look really good. So that should help make them feel better as well, even though now rates are kind of coming down. So savings rates will start to go down as well. Okay, so that's trend number 3. Let's go into trend number 4. I'm doing good on time here. All right, this one's a crazy one. This one has changed a lot since I first gave this presentation, but it's still a trend, I think. And that's the politicization, that's a big word, politicization of ESG investments. So again, let's start with some definitions so we all are speaking from the same page. There's different names for this. You might hear it called socially responsible investing, or SRI, or impact investing, sustainability, maybe just that one word, ESG, environmental. So for the purposes of this trend and this presentation, I'm just going to refer to all of that as ESG, which stands for environmental, social, and governance. I'm just going to that's going to be my kind of blanket term for those different kinds of things that are out there. Okay, ESG investing has really grown in popularity. So in 2020, $51 billion flowed into so-called ESG funds. They had some kind of ESG flavor to them. It was about 25% of all newly invested money. The assets of ESG funds went from 12 trillion in 2018 and jumped by another 5 trillion in just 2 years to 17.1. That's huge. A lot of money flowing into these ESG funds, even today. But the question is, what about investment returns? If I'm investing in an ESG fund, do I get the same rate of return as a non-ESG fund? And that's a good question. And I think the data is still kind of out there, because if you were to Google search, you'll get something like this. You'll get a bunch of those. Investing sustainably means sacrificing returns. It's like the same article from all these different sources. It's all over the place. So it's still an unknown. But let's for a second talk about how ESG is actually implemented in an investment fund, in a product, a mutual fund or an ETF that's marketing itself as having ESG. How is that ESG factor implemented? What are they doing to make it ESG? Well, there's really only 2 major approaches. There's an exclusion approach, and there's an overweighting, underweighting approach. And you can see there's like the slash, or there's the scales, okay? So the exclusion approach, pretty simple. That just means that a fund manager or fund company, if they have an ESG fund, they're just going to exclude specific companies or entire industries from a fund. They're going to say, we are owning, for example, nothing that's coal related. And you will find 0 coal related companies in our fund, as an example. That's exclusion. They're not even going to buy a little bit of it. They're doing nothing. 0. Okay. Then the overweighting and underweighting says, well, we're not going to exclude necessarily, because that kind of shrinks the universe of available companies in our fund. But what we're going to do is we're going to own more of those companies that have strong ESG qualities, and we're going to own a lot less, or a little less, depends, of companies that have lower ESG qualities without excluding. So we're going to overweight the good ESG companies, and we're going to underweight the so-called bad or not so good ESG companies. That's really how it's done. The problem is you have issues with both approaches. There's a lack of diversification. So I mentioned earlier about diversification. You want to own a lot of things, so that if you're not putting all your eggs in one basket, you reduce your diversification, particularly with the exclusion method. Now you're excluding the set of companies that an investment fund can purchase within their fund for their investors shrinks if you're excluding whole companies and industries. Because there's all this management involved and analysis and ESG, and it just takes a lot more work on the part of the fund companies. ESG funds generally cost more than to the investor than a comparable non-ESG fund. And here's really the kicker, is that there's no one approach for implementation. There's these 2 broad approaches that I outlined, but each fund company is going to do it their own way. So you have these ESG scores across these funds. Like, for example, if you look at Morningstar, but you're not comparing apples to apples, because fund companies are doing it all the same way. There's no consistent method across funds as to how to really implement and rate the quality of a fund that's marketing itself as ESG. So that's a big issue. And then you have the government regulation coming in. So in November of 2022, the Department of Labor issued what's called the ESG rule, which basically said they announced that there's a rule, they published a rule in the Federal Register to remove barriers for considering ESG factors in plan investments. So Department of Labor is the regulator for ERISA, which is like 401k plans and 403b plans, qualified retirement plans. And so they're now saying that before there was a question, if you were providing a 401k plan for your employees, if I provide these ESG funds, am I going to be liable for the fact that these ESG funds have either exclusion or however they're rated, and that maybe they won't do as well? And so plan sponsors are very leery about those. And now the Department of Labor comes along and says, don't worry about it. We're going to remove all those barriers to considering these funds. We want you to own them. We want you to put them in your 401k and 403b plans. There was a court challenge, which had survived last year. But then there was a backlash. So, for example, in September of 2022, the Wall Street Journal, the headline was, "An anti-ESG activist investor presses for changes at Apple and Disney. He doesn't like ESG." Well, who was that? Hey, that's Vivek Ramaswamy, who was a nobody back then. Well, he wasn't a nobody. He was an activist investor, but now people know him as a former candidate for the presidency. That was him. In January of 2023, the Biden administration got sued to stop it from risking American workers' retirements by promoting "quote unquote" woke ESG goals. That goes back to the ESG rule that was passed. And it's like, there's just a backlash. And it continued. In August of last year, the Conference Board issued a survey results that said 61% of companies surveyed expect ESG backlash to continue or increase over the next 2 years. And what did they recommend? Well, they recommend that corporate boards and management view backlash as an opportunity to clarify their ESG strategy and communications. So you have companies who are expecting more of a backlash. And then to cap it off, in January of this year, the Wall Street Journal published an article called "The Latest Dirty Word in Corporate America is ESG." And executives are switching. Now we're talking semantics. They're switching to other terms like responsible business to describe corporate initiatives. All of which is to say, and this is kind of another quote from that article: "Adding to the challenges for companies is that some dimensions, particularly the social goals, can be difficult to quantify." What are we trying to accomplish here? And what's the best way in which to accomplish it? So it's been politicized. Let's go with that. And so I would argue that if someone is interested in ESG, if this is like a personal value of theirs, that they would be more effective doing it through their charitable giving than through their investment portfolio. It's so difficult to do in a portfolio, and you don't, again, like I said, there's no consistency. It's very political. ESG held in an investment portfolio, that's really more of a values-based decision. Okay. It's very important. But what's the impact on the corporations that are in the portfolio? Are they really suffering from the fact that you own an ESG fund? So again, I think charitable giving is the better way to do this, but of course it is a values decision. So for this trend, again, think like a financial planner. Data gathering is going to be critical here. Ask questions. Does the donor have an interest in ESG or socially responsible investing, or whatever term you choose to use? Does the donor own any ESG investments? This is something that you might want to know. And if so, what are they? And what method do they use to measure ESG? Is it exclusion? Is it over and underweighting? Or is it maybe something else? And what is the expense to the investor? What is it costing you to be an owner of this investment? It's going to be more than just a regular old index fund, which are almost free these days. So then, it's about how well do you know your donors? Because this is a political kind of a trend. Are they for ESG investing? Are they anti-ESG investing? Are they indifferent? Just be careful. You don't want to step on any landmines when you're talking to a donor. And then you want to be prepared if you have an endowment. You want to know the answers if a donor asks you questions. What are your organization's ESG investments, or what's your investment policy? So you want to be prepared to answer that, know the details if the conversation turns down that road. And so maybe it would be helpful. I would recommend maybe developing a relationship with a financial advisor who uses ESG investments, so that you have someone to turn to ask questions and to provide some information perhaps to donors. Okay, last trend, number 5, advanced tax planning. Okay, so you all remember the Tax Cuts and Jobs Act, of course. It's been in the news a lot. In 2017, passed at the end of 2017, it increased the estate tax exemption amount to 11.18 million per person. This year, today, because of inflation indexing, it's at 13.6 million per person. Okay, but as we all hopefully know by now, its days are numbered. It sunsets at the end of 2025, and the pre-Tax Cuts and Jobs Act rules come back. You're at a New Year's Eve party at the end of 2025, the ball drops and boom, now we're back to TCJA rules on January 1st, unless Congress does something. Will Congress do something? Let me think about that. Anybody here remember 2010? Yeah. So there was another law that was sunsetting, and in 2010, there was going to be no estate tax whatsoever. And the talk in 2008, 2009, oh, Congress is going to do something. They're not going to let this happen. There's going to be an estate tax. No, they didn't do anything. So in 2010, for that whole year, the estate tax gift was repealed, not the gift tax. The estate tax was repealed for one glorious year. And the famous story of New York Yankees owner George Steinbrenner dying in 2010 and taking advantage of the fact that he had a huge estate, no estate tax. There was a basis, and there's some things, there's some kind of qualifiers around that, but basically the tax was repealed. Then, of course, it came back in 2011 at 5 million. And you can see that in 2018, it went up to 11.18 with the Tax Cuts and Jobs Act, and it's been kind of creeping up steadily ever since. Okay, well, what does that mean? Who knows? What's going to happen? I don't know. I don't have a crystal ball. Nobody knows. The challenge is that donors, individuals who are free of an estate tax concern now, they may not be free of that concern come 2026. Because if they're on the bubble, if the Tax Cuts and Jobs Act sunsets and the estate tax exemption drops from, let's say next year, it'll probably be in the 14 million range down to, they're saying maybe in the 7 million range, something like that. It's going to basically get cut in half. And donors who have a net worth that right now, it's not an issue, but if that happens, it will be an issue. There's just a lot of uncertainty. We don't know. My thing is that we can only plan with what we know today. We can't plan for hypotheticals. We can talk about what ifs and we can lay out different scenarios, but it's no sense taking any action, because any action you take on something that isn't certain could be detrimental. So we can only plan with what we know. Then we had the Secure Act 2.0, which passed in 2022. That made a bunch of changes. It increased the age for taking required minimum distributions from to 73 beginning last year. It will now also increase another 2 years in 2033 to 75. And that's after Secure Act 1.0, it increased it from 70.5 to 72. We had a very short period of time where it was 72 and then it went up to 73. The Secure Act 2.0 also made some changes to 529 education plans. You can now do some rollovers into Roth IRAs with unused money. There's some rules around that. Made a bunch of other changes to qualified retirement plans and some new rules for qualified charitable distributions. Let's talk about that. First of all, the maximum annual qualified charitable distribution. Now, again, that's going from an IRA directly to a public charity, not including donor advised funds. Not yet anyway. The maximum qualified charitable distribution had been set at $100,000 and wasn't changed. Now it's indexed for inflation, which started this year. And this year it went from $100,000 to $105,000 per person. That's nice. And it's going to go up each year. Very nice. It also, the Secure Act 2.0 allows for a one-time qualified charitable distribution to a CRT or a CGA. Now that started last year. Now, there's some issues with this. There's a lot of strings attached to this one-time qualified charitable distribution, especially when it comes to CRTs. Now, the maximum that someone can make a qualified charitable distribution to a split interest gift like one of these is $53,000. That's this year's number, indexed for inflation. You can only do it in a single year, so you can't repeat it in multiple years. If it's a charitable remainder trust, it must be funded exclusively with qualified charitable distribution dollars. So if a donor has an existing CRT that was funded some other way, they cannot add to it with qualified charitable distribution dollars. They have to create a whole new CRT, which there's legal expense to that. There's administrative expense to that. And with this lower $53,000 per person cap, I mean, I don't know that it makes a whole lot of sense. Other strings, the income beneficiaries can only be the IRA owner and the spouse, so no one else. And here's the thing, all distributions are ordinary income. You get no capital gains favorable treatment, because if it's a qualified charitable distribution from an IRA, that's all pre-tax dollars. And so you don't get any capital gains. It's all ordinary income. So for a CRT, I don't see this as really a thing. I think it just doesn't make sense. Maybe that'll change down the road. For a charitable gift annuity, yeah, that's a more likely vehicle of choice. I've talked to some gift planners that have funded charitable gift annuities with QCD dollars, coupled strings there. It can only be an immediate CGA, and it's not assignable, and there's a 5% minimum annuity rate, which with current interest rates shouldn't be an issue. But this is kind of much ado about nothing, I think. I wouldn't, Stelter may have a different opinion as to how heavy to market this particular thing. But especially with CRTs, I just don't see it as being very effective for the donor. So some Trend 5 hacks. You want to stay abreast of changes in the tax law because they're coming, like it or not. If Congress does nothing, the tax law will change. If Congress does something, the tax law will change. And you can really be a great resource for your donors and for their professional team by staying on top of this kind of stuff. And by the way, using a qualified charitable distribution to lower a client's taxable income, that's a no-brainer. Whether forgetting the split interest gift, if a donor is eligible for a QCD, they should be using this up to the maximum for all their charitable giving, because it's going to lower their taxable income. I mean, it's really, really kind of a no-brainer. A few other tax strategies for Trend 5, the advanced tax planning, is bunching charitable gifts. You hear about that a lot. Doing multiple gifts within a single year to take advantage of itemized deductions for the donors who are currently taking the standard deduction. That's something. I mean, I don't know how practical it is for people to make large gifts when they were making smaller gifts each year, but that's still out there. Of course, giving away highly appreciated securities instead of cash is always a smart idea for donors who have highly appreciated stock. CRTs and CGAs are great for diversifying concentrated stock positions. So that donor of yours who bought NVIDIA 6 years ago and now it's worth quite a lot more, and they have this huge capital gain, hey, we can diversify you out of that, generate some income for you using either a CRT or a CGA is a great idea. And a CRT, of course, is still a great option for a real estate investor who wants to exit out of their real estate position. Okay. So again, a couple other hacks here. Consider membership in your local estate planning council. That's where you'll meet other professionals, attorneys, CPAs, financial advisors, life insurance, and trust officers who are just committed to the multidisciplinary approach to estate planning. And maybe consider an advanced designation if you don't have one. The accredited estate planner, which is through the Estate Planning Council, the CSPG, full disclosure, as Nathan said, I'm on the faculty of that. The CAP, Chartered Advisory and Philanthropy, is also a designation you can seek out. And I'm going to conclude on this, a word about elections. Okay, elections are coming up. Everyone's always nervous. What's going to happen? I give you this chart. The words may be a little hard to read. Those are the different presidents that were elected. This goes all the way back to 1926 through the end of 2023. So the blue on the far right is Biden, and then the red next to that is Trump, and then you have Obama, Bush, and so on. Markets have rewarded, if you're a long-term investor, the market has been solid under a variety of US presidents. In other words, there's no connection between who gets into office and what party they belong to and how the market does. Over time, it tends to go up. So I'll leave you with that. And I want to say, again, in conclusion, think like a financial planner. Don't be the donor's financial advisor or financial planner, but just think like one. Follow the trends that are out there. I gave you 5 here today. Do a lot of detailed data gathering. Ask some good, thought-provoking questions, not just yes or no questions, but really ascertain the data that you need. The fiduciary duty, you as gift planners aren't subject to the fiduciary duty like I am, but I want you to think like you are, and that is always asking yourself, what's in the best interest of the donor? And that's the way you should operate. And I know that all of you are doing that. And so again, I want to thank you. And now it's time for some Q&A.
Thanks, Juan. Thanks so much. I'm just going to invite everyone to go ahead and send your questions in through the Q&A. I did have one woman who emailed me last week when she registered for the webinar. She had a question, so I wanted to address that one first. Her name is
Okay.
Catherine, and she's wondering, she talks with a lot of donors who say that everything is going to go to their children. So they can't give a gift because they're going to leave their estate to their children. She's wondering if you could talk about some giving options that would include a gift to the charity that would also minimize the tax impact on the estate and for their heirs.
Well, yeah, it's very common for donors and for anyone to want to leave their assets to their kids. The question is, I think this is one of those situations where, again, thinking like a financial planner, you want to do some data gathering. So I don't know, for example, if the donor in question has an IRA and they're going to leave that IRA to the kids. Well, the IRA is not a great asset to bequeath to the next generation, especially if we're talking a non-spouse beneficiary. They're going to be subject to required minimum distributions starting next year. Let's someone passes away this year, for example, and a non-spouse beneficiary inherits that IRA. They have required minimum distributions every year, and then the entire account has to be distributed after 10 years. So is that something that you want for your kids, or is it smarter to leave them another asset that's more tax efficient for them, and then maybe consider the IRA for charity? Or maybe consider the IRA, depending on the size of the IRA, maybe how about a testamentary gift, a testamentary charitable remainder trust that the IRA goes into, and now it's paying income to the kids for a certain number of years, but then the remainder goes to charity. It's another way of kind of doing the same thing. So I think it's just a question, again, of kind of understanding what their assets are. So finding out what the scope of, here are their after-tax brokerage accounts, here are some IRAs, and then if they're a donor, then it means they like your organization, and then just kind of figuring out where can I kind of maybe carve out a piece that might make sense to give to charity, because for tax efficiency reasons, maybe.
We also have someone who is saying, since they're not actual financial planners, most of the people on the call,
Right.
do you have suggestions on gathering the data on the donor's assets during discovery? It's difficult to get this data when they're trying to cultivate their relationships with their donors.
Of course. I mean, this is one of those things where you have to just get a feel for it. So I remember meeting a donor for the first time when I was with the ALS Association, and I was at her rather lovely. She was in like independent living community in Virginia, and she was a widow. And I show up, and we chatted in her living room for a few minutes, and then it was lunchtime. So then she took me to lunch, and then she would like grab my arm and walk me into the cafeteria, and all of her little friends were looking. I'm like, am I arm candy here? Like, what's what's going on? And we had this lovely lunch, and then we went back to her apartment, and we're just chatting there again. And so just cultivation. And then at the end of that, she goes, I have a question about my accounts, my bank statements. Can I show you my bank statements? And I was like, yeah, okay, let me tell you. I'm happy to take a look at them. So I think sometimes you kind of have to get a feel for when it's appropriate to ask. So hopefully you obviously don't want to ask right off the bat. You want to establish that empathy and that connection with the donor, and maybe you don't do it on the first visit. Maybe you plant the seed for a second visit as an option, and you say, I've had such a great time meeting you today. I'd like to come back with you and maybe dive a little deeper into your situation and maybe discuss some ideas that might be mutually beneficial for us. Would that be all right if we do that next time we meet? And then the next time you come back and you start saying, one thing that would help me to really help you. We're very grateful for the gifts you've given, but one thing that would really help me is to really understand what it is that you have, because sometimes there's certain assets that can be given away, whether it's to us or to somebody else, that may be more tax efficient. So could I ask you a few questions about that? Would that be all right? So then you kind of ask for permission, and then you get into it. So I think it's all just in the approach, the questioning, being understanding, being empathetic, and during the course of the cultivation, you'll get a feel for that.
Perfect. Nathan, did you have a question? Oh, you're muted.
Of course, somebody had to do it. Yeah. I mean, there's a couple other questions that came in here too. In particular, Marianne had a question around the benefit to the donor of giving QCDs to nonprofits, aside from benefit of avoiding taxes.
Yeah.
The relation of using the RMD QCD gift to the income used to identify the donor's income level for Medicaid annual expense.
Okay, so for Medicaid annual, is that what you said? Medicaid annual
Yeah,
expense?
that's what it looks like here. The relation of using
Well,
earned. Yeah.
I think maybe, I don't know if you're talking, if they were talking, you're talking specifically about Medicare. There is something called the Medicare income related monthly adjustment amount. So in other words, if you have too much reportable taxable income on your tax return, your Medicare premium can bump up depending on your modified adjusted gross income. And so if you have required minimum distribution reportable on your 1040 form as taxable income, you can do QCDs. This is another benefit of giving away the IRA dollars, because not only does it satisfy the required minimum distribution, it lowers taxable income. And so one of the side benefits of that is potentially avoiding the Medicare premium adjustment that might happen if you make too much money on your tax return. It also can lower on the itemized deductions, where your medical expenses are based on 7.5% of your AGI. The lower your taxable income, the lower your AGI. So you can actually deduct more medical expenses if that threshold is lower. Potentially less of your Social Security income would be taxable because there are income thresholds to that. So there are a lot of little side benefits that trickle through the tax return by using QCD dollars. That's why I'm a big advocate of use QCD. If you're eligible, use those first to do all your charitable giving and get rid of that required minimum distribution as much as possible, because it has all these other benefits. I don't know if that's what she was referring to, but that's kind of what I'm getting from that question.
Yeah, I think that's what she was probably referring to.
Yeah, good stuff.
Does it make sense to talk with prospects who have a 401k and a 403b retirement account to roll them over into IRAs so they can take advantage of the QCDs? And what would be the trade-offs?
The answer is generally yes. So again, if a donor, and I see this every once in a while where someone will come in and they'll have an old 401k from an old employer, and it's still with the employer, and the employer doesn't have the right to kick them out of the plan, so they just keep it there. But yeah, the only way you can do a QCD is by rolling it into an IRA. So the issue is who's going to manage that IRA? At least as long as it's in the 401k, you have some professional management with the 401k plan administrator and so forth. But if you roll it into an IRA, if you're working with someone like me, then obviously we would be managing that for the client. But otherwise, they would have to be managing it themselves. So that would be the trade-off. But if they're doing it for the purposes of QCD and they're just sending the money right out, maybe they can keep it in the 401k, take a rollover to the IRA for purposes of doing the QCD and then pushing out the QCD. But they're going to have required minimum distributions from the 401k if they leave the money in there and they are now currently age 73 or older. So it might make sense just to get rid of everything in the 401k, move it into the IRA, and that way you don't have to worry about taking required distributions from the 401k. It's all in one place. I'm a big fan of simplification and consolidation, especially as clients get older. I get nervous when clients have a bunch of accounts all over the place, and especially from an estate planning standpoint, you have to put your arms around all that stuff. So I really like consolidating, and just makes life a lot easier. This could be one of those examples, but yeah, generally it would make sense. Again, the trade-off is if you're going to roll the whole amount is who's going to manage the IRA. If they're working with an advisor, then that's not a big deal.
I've got here, Kim had a question, and this is really around positioning or ways to talk to donors about annuities, commercial annuities versus gift annuities. In fact, she recently saw that Elton John's farewell tour was sponsored by the Nonprofit Alliance for Life Income, which promotes annuities, but not gift annuities. So any tips on ways to talk to donors about the difference between the two or the benefits?
Yeah, I mean, so, life insurance companies, which are the ones who offer annuities, they're in the business of making money. So, I mean, annuities, to my mind, commercial annuities, there's a very limited, I think, use, like subset of people that could really benefit from those. I think for the most part, they're oversold. Just my personal opinion, because you can do a lot of the same things. The whole appeal of a commercial annuity is that you're having this quote unquote guaranteed income. Well, yeah, that's true, but how much is it costing you to get that guaranteed income? Life insurance companies aren't in the business of losing money. They're not going to offer you some huge payout unless they're collecting fees somewhere else to offset that, especially if those annuities are invested in just bonds. And if bonds, as you saw from my chart, are paying, the highest yielding bonds are paying like 5-6%, then they need to make a spread somewhere. If they're offering the annuitant a certain percentage amount, they have to charge a certain amount in order to make it profitable. So, you know, I'm not a big fan of commercial annuities, as you could probably guess. You know, again, I think charitable gift annuities, the real benefit there is there has to be some charitable intent to them. You know, in other words, because otherwise, if you were to compare them side by side, the commercial annuity is always going to win out, regardless of the fees for getting that side of what I was just saying. But if you just kind of compare them just on the face of it, the commercial annuity is always going to offer a higher rate than the charitable gift annuity. It's just that there has to be some charitable intent to motivate the donor to go for the gift annuity as opposed to the commercial annuity.
Can a donor use an SEP or a simple retirement plan for a QCD? This person has an advisor who says yes.
That is a good question. I should know the answer to that off the top of my head. Those do have required minimum distributions if you get to be the age. So I think I want to say yes, but I'll have to go back to the drawing board and just double check that and fact check myself. Normally, if someone has a SEP or a simple and they're no longer the business that was the reason why they created that is no longer an operating business, there's no reason to have it anymore. You just consolidate it in, you know, roll it over into just a regular old traditional IRA, you know, and, you know, why have it? But I think I want to say the answer is yes, but I'll double check that.
Okay. We have someone that says, I worked with a donor who insisted on donating an inherited life insurance payout to their organization despite efforts to steer her towards other assets. What will the impact of this be for her in her taxes?
So, okay, so say that again. So she
An
gave away.
inherited life insurance payout.
Okay.
She donated that to the organization.
Oh, well, a life insurance payout, or if I'm understanding the question, it's just a death benefit from a life insurance policy. Those are received tax-free. So the donor received that tax-free, turned around and gave it to the organization. They get a charitable deduction for that gift. So hopefully
So
they can.
win-win,
So win-win. Yes.
win-win.
Could they have given something else instead? That's a different question. That's more tax efficient, maybe, maybe not. But just to that question, yes, it's a win-win.
Claudia would like to know that even though the RMD from an IRA is increasing, can donors still give QCDs at 71.5 years?
Good question. The answer is yes at 70.5. So
70.5.
70.5. And you want to wait until they've actually hit that half birthday, and then they can do a QCD, even though they for another 2.5 years after that, they won't have a required minimum distribution to make. They could still make a QCD. It'll just be a distribution from an IRA that is not taxable, which actually is fine. That's still a great idea because what it does is you're reducing the balance of that IRA account if you're making QCDs in the absence of a required distribution. And so when you do have required distributions, those will be smaller because they're partially based on the size of the account. So yeah, good idea. I like it.
Great. Okay, and we are out of time. We did have a couple questions we didn't get to. So if you would like to know the answers to those questions, you can reach out to Juan. His email is on the screen right now. You can also reach out to myself or Nathan or visit us at stelter.com to learn more about our products and services. Again, we did record the session today, and I will offer that link to the recording and a PDF of the handouts in an email that you should get from me tomorrow. And you can always go to stelter.com/webinars to view this one and all of our past library of webinars. So with that, we're out of time. Thank you so much, Juan, for spending the last 75 minutes, actually more than that, with us. And Nathan, and we had, I think, around 300 people on the call. So thank you all for being here with us today as well. And check out our website for our next webinar, which will actually be a panel discussion. I'll get all those details out to you. Look in your inbox for that coming probably next week. So with that, thank you again. Thanks everyone for joining us and have a great afternoon.
Thank you.
Thanks, Juan.
Bye-bye.
Thanks, Jen. Really appreciate it.